Thanks for having me this morning. Some of you may have seen me here last year. I did a presentation on financing infrastructure, financing through PPPs. And today, it says Project Finance 101, but really, I'm just giving you a sense of what the space looks like in the region, and really why there's an opportunity for local firms to start collaborating and get a piece of the projects that are out there. I liked your quote, Washira. What do you say? You collaborate to learn, but you also collaborate to compete. And that's where we're trying to get to now. So in terms of my topics, what is project finance? And then we'll look at what project finance projects have been on the continent, where they get their sources of financing, and how we can participate as built environment professionals. So just a definition, reminder for most of you, it's really about project finance being finance raising on a limited recourse basis. So basically, you're looking to finance on the basis of cash flows from your project. In 10 years, between 2003 and 2013, you can see Sub-Saharan Africa closed 158 projects, project finance deals, totaling about 59 billion. What's interesting is, look at what was happening globally. If the projects were 5,000, worth 2 trillion. And we know our continent has the biggest infrastructure deficit. So Sub-Saharan Africa, the size that it is, only made up 3% of the project finance deals. Why is that? Partly because, I think if you could just go to the previous slide, one thing is, historically, over that period, probably the project finance, products in financing hadn't been as common on the continent. We've not been building on a project finance basis. A lot of the banks in the region do not have those types of projects, or do not know how to do the due diligence or credit analysis of project finance deals. The other reason, of course, is we just don't have as many projects that are ready to go through that pipeline. I mean, many of the projects are very capital intensive. We all know the challenges of coming up with equity financing. And so all these challenges have led to that. But that environment is actually changing. Go to the next slide. Look again, in the last 10 years, those 10 years again, 2003 to 2013, 21 countries in Sub-Saharan Africa had project finance deals. Only 21 countries. The 4 biggest gainers are Nigeria, Ghana, South Africa, and Angola, with 17 billion in Nigeria and the smallest being 14 billion in Angola. By looking at those countries, you can see immediately these are capital-intensive projects, so they're not many, but clearly it has to do with extractive industry, mining, and what is the other? Mining. A good chunk of it is mining. Then, but you can see those 4 countries take up 70%. And look at Kenya's share, 1.3 billion. That's barely 2.2%. Partly because of what our economy looks like, and that will be changing, of course, in the next 5-10 years when we start really getting into oil and gas and mining. Africa's projects by area, you can see what that looks like. Majority have been oil and gas. A couple of telecoms, and that's where we've participated. We've had the PPP, but Kenya is also quite present in power, as you'll see in the next slide. When you look at deals that are not from non-extractive sectors, that's what it shakes up to be. Kenya is number 3, but you can see it's considerably much lower than Nigeria and South Africa, when you think that this is the economic powerhouse on this side of the continent. Let's keep going. And these are the deals in East Africa, worth 2.7 billion, which is just 5%. So East Africa only takes up 5% of the project finance deals. And you can see in East Africa, of course, we have 9 deals out of 12, so that's pretty good. We can see we're quite heavy on power deals so far. A lot of the IPPs have been able to secure this kind of financing. And that's really what the environment looks like. Maybe you can look at it for a moment to appreciate it a little more. Okay, let's keep going. So who finances these deals? Generally, these are the players, some to a larger extent than others. The multilaterals, World Bank, IFC, providing grants, providing guarantees, providing concessionary financing, meaning fairly cheap financing. International commercial banks, the Standcharts and Stanbics tend to have a good, fairly well-developed project finance practices. The only challenge, or rather lines of business, the only challenge is that sometimes you're trying to do the deal here, but the person needing to approve this deal is, like for example in the case of Standchart, is in Singapore, or for Stanbic is in SA, and they do not understand our risk profile, they do not know the developers here well, so sometimes that's a challenge. Of course, there's the countries, the projects that come developed from outside, implemented in the country by foreign developers who can access export credit, can access products from export credit agencies, you know, the Exim banks, be it China, be it the US, etc. Local banks, I can mention KCB, CBA, Equity definitely have a bit of the corporate finance and investment banking space. The challenges sometimes with accessing financing from those is the limit, you know, in terms of foreign currency. So if the deal is a multi-million-dollar USD deal, they may have a hard time participating and would prefer a company, a bank like Standchart maybe to be the lead book runner while they participate in the syndication of a deal like that. Of course, there are regional development banks. We know them. The Africa Development Bank, PTA Bank, which is for COMESA. There's also the FMOs, you know, Norwegian Development Bank. There's the German Development Bank. There's AFD, which is from France. They're very active in the infrastructure space and have a lot of products trying to deal with all sort of the financing gaps within the rich space. And of course, there's the non-bank financial institutions, sovereign funds, like the Qatar Fund. There's the private equity funds that come in and have set up. Recently, they're a lot more getting into the infrastructure space simply because of a shortage of the kinds of projects you would want to see in infrastructure. We can say Centum, actually, if you could stay on that slide for a moment. In the private equity space, for example, Centum Investments has gone in a big way and now are focusing on project development. There's the fund, the Africa Infrastructure Investment managers who are partly a subsidiary of Macquarie Group, which is the biggest infrastructure finance group in the world. And they have a presence in Kenya. We have, what else is there? Anyway, private equity is getting quite active. Of course, you can put the Trans-Centuries in that space. And then I talked about AIM, which is an infrastructure fund. So how can we participate? And I'm talking about collaboration at a different level from which Washira was speaking. This is more about, some of us are, yes, we're professional consultants, but you would like to transition to doing some of your work as a project developer. And I think that's a key thing when you're trying to get into the space that some of these other developers, the China Wuis are in, etc. It's really about finding local and international firms that complement your skill or that have the same vision as you, getting a little comfortable with sectors maybe that you're not in. I mean, I've met a couple of architects who I think are doing interesting work in fairly specialized kind of construction related to, you know, requiring certain health standards, certain sanitary standards that maybe are not typical in this market, and therefore they're developing a niche market for themselves. Identifying opportunities, and that of course depends on the vision that you and your partners decide on. But really this should be, the partners that you identify are people that you want to complement your skills and that you want to be with for a long time. It's a marriage. You want somebody who understands how you design, somebody who understands how you think through your projects, and who you can build a vision together. Again, lastly, figuring out what investment vehicles you use. Of course, when you develop, when you're doing a development, you will want to have to set up an SPV, and depending on distributions and tax policy, you might want to decide whether you're going with a LLC, LLP, or unit trust. I think in the early days, you really just want to go with a limited liability company, whereby you form it with your consortium, do a project, and you can disband at the end. But the next level down the road, you may want to set up a fund managing company and set up basically a collective investment scheme, a unit trust of sorts. I think one company, local company that has done a good job of that and has been in it for a while is one called Alliance Capital Partners. The guys who set up, what do you call it? They have a guest house in West. They have student housing in Nganga, where they, brownfield projects, they basically retrofit buildings. And I think they're on track to build the first private cemetery in the country. And they basically have a permanent fund manager whose work is to raise money so that it recycles through their projects. So, in terms of finding money, when you talk about potential investors, I think many of us always think, well, now there's the private equities, all the guys we're talking about. I think it's important to talk to all those because it's good to understand how they assess risk, how they analyze credit. It is important. But when starting off as a group, I think it's always best to start with those that are closest to you. And that's your family, and those are your friends. And really we're not talking about, of course, the big projects that he was talking about, but we're talking about when you're talking about the developments that, a mixed-use development somewhere in town, out of town, you want to think about the people that are closest to you, that can understand the vision, that actually know you, that have done their due diligence on you because they've known you either as a relative, as a friend. And that's where you really start getting your initial equity, because however many banks you talk to, as long as you don't have an equity contribution, 30% or so, that is going nowhere. It's also about interesting ways of structuring the deal. Of course, we all know everyone aims for pre-sales to get a deal going. Sometimes that doesn't quite work out. But if you're trying to get to the next level, really developing a pot of funds that is your equity is a good way to start. Do one project, a proof of concept, start growing your projects as you go along. In terms of talking to your potential investors, be it your family and everything, I think it's important to be quite professional about it and set up a proper information memorandum, talking about what you want to do, describing who's behind the deal. In any deal, if you talk to any financier, the first thing they look for is who's behind the deal, who are the project sponsors, what's their track record, as individuals and as the firm. That's the first thing. And they want to see, by track record is the types of projects you put out, of course, and whether you've been able to exit those deals, if that's the plan, or if you're holding them, what are you doing? What are the returns on your deals? Otherwise, you can't attract too much money. Then, again, knowing what it is that you're offering, what's on offer on the table in terms of their return. And you can have money that you get from an investor for a couple of years, or that you want to hold for 10 years. It's about you understanding how to structure it and make it attractive to those people. They can exit in 2 years, and there's an option to cycle it back into your deals. That's the way to think about it. But bottom line is you have to provide a really clear vision as to what you're trying to do. Next thing I think that is important is really being in the know. Knowledge acquisition. For knowing what it is you need. Like now I'm talking about financing. I think it's important for everyone in your space, if you're looking to get into those deals, really to develop a certain vocabulary around financing and understand structures of financing, understand the players of financing, and that's really just getting out on your day of talking to a few people and just gathering some knowledge. But also not just in financing, you need to know a bit of the legal side and what that means in terms of your ability to protect your investments and to protect other people's investments. That's just a list of the kinds of projects really that one could participate in. On the infrastructure side, I'm looking at the big infrastructure side, be it housing, hospitals, there's a lot of opportunities, and of course at the county level, even just private, fully funded private deals. Let's not even talk about PPPs. There's some that are quite amenable to that. Next slide. Way forward, I think it's all about execution, really. You just have to start. If you're in that space, if you're thinking about it, it's about taking that first step. Don't overthink it, but be ready to keep refining your ideas and your plans as you learn more and as you get the right partners. One day you might have the wrong partners, and be swift in acting to change your partners. Maybe in the early days, do not get into a permanent marriage. Work on MOUs, work in a less formalized fashion. But work towards refining your team and finding the team that will enable you to get to the next level. I don't know how many minutes I have. 2 minutes? I think I'll leave this. Anyway, so that's really what I'm looking at. But the reason I think this is important is, as you heard, some of the deals I'm working on, many of them, actually all of them, the lead team is a foreign firm. And for some, for various reasons, for certain technical reasons, we need to have some of those. But majority of the other people in the team are local. So why can't we be at the point where we're actually the ones leading some of these deals? I don't think that, I think we should be able to lead, we should be able to bring the expertise that we may not have, but they don't necessarily need to be leading the deal. What we see is we know the environment best. We know the designs that worked for this place best. And we actually know about the financing better than most of the guys that come out. So at the end of the day, it's not really that the firms out there know better. It's just that they respond quicker. And why do they respond quicker? They have an appetite for risk that many of us don't. And one needs to get comfortable with a bit of risk. They have the ability to get to the information fairly quickly, even though they are away. We probably are getting the information sooner, but many are very skeptical about many of these big deals. And that's what we've seen. At the pre-qualification stage, many local firms participate. Many local firms come to the bidders' conferences. But when it comes to actually submitting the work, no submissions come in, oftentimes. And meaning you've just struck yourself off before you've had an attempt to try out and do the deal. There are many of the international firms that come that you really have to determine, give them a chance and see. They have met most of the conditions, and you wonder, is it enough that we fail them on the basis of what's left out, or shall we just let them move forward and work with them to refine the last part? And that often happens. So why can't we give that chance to ourselves? To come in with deals, do our best, put it in, just throw your cards in there and see what happens for the next deals that are coming down the pipe. Thank you.